session, which we thank LASEA for giving us this slot to present the results from one of the analytical chapters of the latest regional economic outlook of the Western Hemisphere Department of the Fund that Samuel has just posted in the chat. What we do in this chapter is basically take a 30,000 feet look at the structure of taxation in Latin America, seeking to improve in terms of collections in a manner that is growth friendly and inclusive. And we focus, I mean, the VAT has been the cornerstone of the structures in the region for almost half a century. So we focus mostly on direct taxation. And from there, the work of Santiago and Samuel is going to show two main facts and associated prescriptions, if you want, or recommendations. One is that we collect very little on the personal income tax, and there are some very obvious design flaws, and that this could be complemented with an earned income tax credit to make it very inclusive and perhaps have a positive effect in reducing informality. And the second observation and result is that if you look at statutory rates for the corporate income tax, the advanced economies have been lowering those rates in some cases below 20%, while the largest economies in the region continue to charge, rates at 30 or even above 30, with Colombia recently increasing those rates. So our chapter explores a little bit the implications of these major stylized facts, if you want, and Santiago and Samuel will present the details in the next 20 minutes. And we thank very much Carola Pesino at the IDB, who has been doing research in this area and also pushing for the earned income tax credit to give us her views and show us a little bit of complementarities or differences between her research and what our team is going to present. So with further ado, I give the floor to Santiago, I believe, and then Samuel.
Sure. Thank you, Jorge. Let me share my screen to kickstart the discussion. So I assume that you can see the screen properly here, right? Okay, so we'll start. Thank you, Jorge. Thank you. Thanks to the organizers of the conference for inviting us, and thanks to Carol as well for accepting being the discussant of this chapter. This is joint work with Samuel Nagura and Carlo Piccinelli under the supervision of Jorge Roldós, and the idea of this presentation is to do a brief overview of the main findings of this regional economic outlook chapter on tax policy for inclusive growth in Latin America and the Caribbean. Let me kickstart with a brief summary of the main findings and messages of the chapter. We found that key taxes in the region could be simplified and redesigned in order to raise revenue in a growth-friendly and inclusive manner. We focus mostly in this chapter on direct taxes, as Jorge mentioned. In the case of the personal income tax, we found that it would be important for many countries to address important design flaws in the PAT system, while at the same time to streamline the widespread deductions that tend to benefit mostly relatively rich households in the region, while also introducing an earned income tax credit, or EITC, to incentivize labor force participation. These elements could help raise revenue, improve equity, and help with growth. In the case of the corporate income tax, it could be important for some countries in the region to align rates with those observed in other regions, to the extent that these are assessed to be relatively high, as Jorge mentioned, while at the same time to broaden the base of the corporate income tax. This could help attract investment, foster growth, and also help prevent further base erosion of the corporate income tax in the region. We also look at the value-added tax in LAC, and we found that some countries do seem to have space to improve its design, But in this case, it's of course important to undertake improvement measures regarding the VAT while taking into account compensatory measures to compensate vulnerable households in the region. We also look at other untapped revenue sources in the region, namely property taxation, more generally speaking, wealth taxes, and also environmental taxes. And we discuss how these taxes could also be strengthened in the region in a growth-friendly and equitable manner. So we start the chapter by doing an overview of tax structures in LAC before the pandemic, and we compare them with those of the OECD countries, excluding LAC countries, because of the relevance of the OECD for the region, and also because many OECD countries have interesting design features in their tax systems that we believe LAC countries should aim to replicate in many cases. And in a nutshot, despite improvements in total tax revenue collection over the last 15 years or so, still LAC countries collect significantly less total tax revenue relative to OECD countries. We're talking about 22.4% of GDP for the average LAC country and 35.5% of GDP for the average OECD country as of 2019. What explains this gap? As we can see from the table, to a large extent, this gap is explained because of the low collection of personal income taxes, as Jorge pointed out. As of 2019, the average LAC country collects a quarter in personal income taxes relative to what the average OECD country gets, and even the country in the region that gets the most PAT revenue gets about a half of what the average OECD country gets. On the contrary, when looking at corporate income taxes, you can see that the region relies much more on corporate taxation relative to the OECD. And finally, in the case of the VAT, we can see that there is still a gap between LAC and OECD countries, but this gap has been shrinking over time. And as of 2019, some LAC countries even collect more tax revenue relative to the average OECD country. Probably many of you at this stage are thinking to what extent differences in income levels between LAC and OECD countries explain these differences in level and tax structures in collection, thinking about design, features, and also enforcement capacity of taxes, and also informality levels, of course. As we discussed in the chapter, these are critical issues explaining the underlying trends in taxation in the region. But in our view, this is not the whole story. And we try to point this out by putting together a new data set that covers about 50 years of tax revenue collection for OECD countries and about 30 years of tax revenue collection for LAC countries. And we associate tax revenue collection levels with the GDP per capita observed by each country over time. And then we organize the data set in ascending orders by GDP per capita. The blue markers over here represent the median value of income per capita of the different OECD countries and what would be the associated tax collection level given that GDP per capita level. The other markers represent tax collection for LAC countries as of 2019 and the OECD average for 2019. And the message is very clear. When looking at corporate income taxes, we can see that not only LAC countries collect much more than OECD countries for corporate taxation, but also they collect much more relative to what OECD countries were collecting back in time when they had similar levels of GDP per capita. A completely opposite image arises when looking at personal income taxes. We can see that not only the region collects significantly less PAT revenue relative to the OECD as of 2019, but more strikingly, they collect significantly less PAT revenue relative to what OECD countries were collecting back in time when they had similar levels of GDP per capita, thinking about Portugal, Spain, back in the 80s when they had similar GDP per capita levels as some LAC countries today. Of course, for many of you, when thinking about rebalancing tax structures towards more collection of personal income taxes, an important issue arises in terms of to what extent this could negatively affect growth. This is a question that we also tackle in the chapter. And let me briefly explain you how we do that. First, we build on the data set that I was referring to before. But before going into the nitty-gritty of the econometric model and exercise that we do in the chapter, we also discuss this from theory what it would be expected for different taxes to affect growth in terms of the relation between taxation and growth. And we know a little bit from theory that in principle, consumption taxes tend to be more growth friendly than income taxes because investment is excluded in principle from the base of consumption taxes, whereas a higher reliance on investment may have a detrimental effect on labor force participation decisions and also on investment, and thereby affecting growth in a negative way. With those insights in mind and using the data set that I was referring to before and building on my own research and some other related research on the subject, we try to understand how tax reallocations between the VAT, the PAT, and the CAT in revenue neutral context affect long-term growth. And the results are summarized here. We do that exercise for LAC countries and for OECD countries. The results, the main results for LAC countries are reflecting these blue bars, and for the OECD countries in the red with the red markers. And the bottom line is very clear. The VAT is significantly more growth friendly than both the PAT and the CAT in the region. An important message from that analysis, of course, is that transitioning towards more collection of personal income tax in the region should be done carefully in order to prevent potential adverse growth effects. The other important message that arises is that, in fact, perhaps the high reliance of corporate income taxes in the region may have had detrimental growth effects, and this result is significant and very robust. Interestingly, when looking at the results for OECD countries, we can see that there is no trade-off in terms of growth between raising revenue with either the VAT or the PAT. And to us, this is a very important result because it seems to imply that to the extent that the PAT is properly designed and enforced, perhaps this growth trade-off tends to vanish. And this is something that we emphasize a lot in the chapter, which is the relevance of designing properly the PAT. Finally, we still have these negative effects of corporate taxation on growth, even for the OECD sample. And this result is consistent with also other results from the literature that look at OECD countries. As I mentioned, these results tend to be very robust. We have all the details in the chapter, and also in the annex of this presentation, I put a little bit of details of what we are doing in these econometric regressions. But of course, thinking about growth is not the only aspect that we have to be concerned about. As Jorge mentioned, especially after COVID, issues about income distribution are of critical relevance. But in order to look at that in detail, it is necessary to look at each tax design in isolation. And this is what we also do in the chapter. Let me start with a brief overview of the VAT. Basically, for this chapter, we put together a new data set that covers different design elements of the VAT in the region, and we compare those with OECD countries. Some broad design elements of the VAT are summarized in the left-hand side chart, where we have statutory rates for the region, and we compare those with OECD countries, but we also have effective rates. So we put together a new data set on effective rates on VAT. And the message is very clear. In terms of statutory rates, LAC 7 countries appear to have rates aligned with those of OECD countries. The rest of LAC seem to be having statutory rates a notch below those of the LA7 countries. But interestingly, when looking at effective rates, we start seeing a gap between statutory and effective rates. And what explains this gap? Of course, as we know, exemptions, reduced rates are critical to explain the undermining of the VAT base in the region, but also, and very importantly, informality levels. This is somehow summarized in a condensed way in the right-hand side chart, where we have this measure of VATC efficiency, and it is clear that some countries in the region appear to have a space to improve the efficiency of the VAT towards being closer to OECD levels. An important message that we bring about in the chapter is that at the time of thinking again about improving the design of the VAT, or in some cases to reassess statutory rates, it is important to have adequate safety nets in place to compensate vulnerable households. In the chapter, we also discuss the important issue of the digital economy and the VAT. A key message there is that the digital economy should be taxed essentially the same way as other sectors in the economy, in particular to prevent possible base erosion on the VAT. Namely, you have local retailers that are VAT compliant that suddenly perhaps decide to become e-commerce retailer because of tax advantages. Is something that we need to avoid, of course. Now, when thinking about the corporate income tax, we saw from the cross-country regressions that these tax tend to be highly associated with negative growth in the region, more generally in OECD countries. In terms of some basic design elements, on the left-hand side chart, we have statutory rates. As Jorge mentioned, we have this race to the bottom in statutory rates followed by OECD countries, also in the case of many LAC countries, but we don't observe that pattern with the statutory rates for the average of the LA7 country in the region. Perhaps because of these relatively high statutory rates, many countries in the region have offered very, very generous tax exemptions and special regimes to attract investment. And of course, this not only undermines the base of the corporate income tax, but also generates a plethora of inefficiencies across sectors in the economy. Some of these issues with base erosion are reflected in what we call a CAT productivity indicator, another type of measure that we put together in this chapter to understand a little bit the quality of the corporate income tax in the region. And the message from the right-hand side chart is also somewhat clear. Those countries that appear to have relatively high statutory rates seem to have low productivity of the CAT because of erosion of the base, also enforcement issues, calling for attention also regarding the design of the corporate income tax in the region. We also look at the ongoing global corporate tax reforms, and we assess in the chapter a little bit about which could be the implications for different countries in the region, which of course tend to be very heterogeneous depending on the statutory rate level of different countries and some other structural elements of the economies. Now turning to the PAT, let me give you some broad design aspects of the PAT in the region. On the left-hand side chart, we have statutory rates. As we can observe from the chart, both the minimum rate and the maximum rate tend to be significantly below the rates for OECD countries. Very importantly, also, the income thresholds at which the rates apply tend to have a gap with OECD countries. Not so much in terms of the minimum thresholds, so how much an individual or a household need to earn in order to start paying the minimum rate. That seems to be more or less aligned with the thresholds of OECD countries, but we have a big gap in terms of the maximum threshold at which the maximum rate applies, which is already significantly below the rates of OECD countries. So there is an important design element that we believe countries need to look at as well. Of course, when thinking about the incidence of the personal income tax, it is not enough to think about statutory rates, but we also need to look at effective rates. And to that, it becomes necessary to understand how deductions work in the region, and to understand also the incidence in terms of income distribution. We need to also look in detail at tax codes, which is what we do also in the chapter. But let me hand over this part of the presentation to Samuel, who is going to explain a little bit more about our work on the PAT and suggested reforms and simulations that we undertake, suggesting possible avenues for improvement. So Samuel, the virtual floor is yours now.
Thank you, Santiago, and thank you everyone for joining us today. So like Santiago said, with the PIT, the important thing to calculate effective rates is understanding how the income distribution of the country is, and to be able to identify individual characteristics that allows us to impute deductions to these individuals. Santiago, can you go to the next slide, please? Thank you. So what we do in the exercise is, instead of relying on administrative data, we go to the household surveys that have a rich information that allows us to impute these deductions that I alluded to earlier, in addition to gross income, which of course is a crucial element to calculate effective rates. With these household surveys, we do two things. The first thing is, like Santiago alluded to, we calculate effective rates in the region for the LA7 countries, so the 7 largest economies in Latin America and the Caribbean. And then we explore 2 reform scenarios. And these reform scenarios have the objective of achieving several goals. So on the one hand, like Santiago said, the region needs to raise revenue. So that's, of course, one of the objectives of these reform scenarios. The second scenario is the progressive system, which so Santiago mentioned some of these deductions that are in place in the codes favor the rich in practice. So that's another angle. And the third angle that we try to tackle is the issue of improving the efficiency of the system in terms of providing incentives for labor force participation and other angles that potentially offset the potential adverse effects on growth of the PIT. So the first scenario that I'm going to discuss, what it does is to remove the current deductions in the PIT code in the different 7 countries we explore in Latin America and the Caribbean, without touching the statutory rates or the thresholds. So this is important because sometimes when people think about reforms, they think about increasing rates, the statutory rates. Here we're not examining this reform. And the second reform we explore is to do the first exercise, but in addition, putting in place an earned income tax credit in the spirit of what is done in the US. So basically for low-income households, you provide a tax credit for earning wages, right? And this EITC has a specific shape that incentivizes labor force participation in the lower end of the distribution, but the phase out of the credit has to be done in such a way that you don't create big jumps so that people want to stop working. A few points that are important to keep in mind when presenting these results is that, first of all, we're doing a regional exploration of these challenges. So we're not going to propose a country-specific PIT reform because this would require a lot of information about individuals and also understand better who is benefiting from the deductions that we explore. So we do a regional look that identifies potential common areas for reform. The other thing that is important to talk about is that these deductions sometimes have a justification, and these have to be carefully assessed when thinking of the practical reforms that countries take. And finally, I want to mention also that our exercise, which has these changes in policies, do not take into account the potential responses by individuals. So this is not a general equilibrium model that we're presenting. This is more a microsimulation that is static in nature, and embedded has the assumption that individuals do not change their behavior as policies change. Sorry. Next slide, please, Santiago. So let me show you 2 things. So the first thing on the left panel, we have the effective rates calculated once you take into account all these deductions, and we're plotting them for a specific type of worker. So here is a single worker with 2 kids. And on the x-axis, we're showing the wage of the individual, but normalized by the GDP per capita of the country. So this is the income of the individual relative to the GDP per capita of the country. So in principle, you should expect the average wage to be somewhere between 1 or 2 GDP per capita, as if you think that the income distribution is relatively normal. And what we show is 2 things. So the first thing is that, of course, the statutory rates in that are progressive. People that earn more do pay more taxes, at least in terms of the statutory rates. But once you apply deductions, on average, you see a very sharp decrease in these effective rates. And here we're not showing country-specific cases, but this average actually hides the fact that many countries in the region, you have a shape of the effective rate whereby individuals up to 3 or 4 times the income level relative to GDP per capita do not pay any PIT in the region. Another important point to consider is that this is not an artifact of evasion or any other thing like this. These are what the codes imply of people that follow the rules. So these are basically base erosion implied by the codes. So let us see what happens when we consider these 2 reform scenarios that I discussed earlier. So the column on the right shows this, and we're going to focus on 2 items. One is the revenue increase experienced after these reform scenarios, and second, the Gini coefficient and the effective rate of the PIT paid by the top 10% earners. So these are measures of how progressive the system becomes once these reforms are taken into account. So notice that on the second column of the table, you see the revenue change increase. And on average, there are big gains to be had of this reform. So in the first reform scenario where we remove the deductions, on average, there's a 137% increase in these revenues that we calculate. So this is basically a more than double in the PIT collection in the average country in Latin America. So these are important gains and shows of how much base erosion the deductions create. Importantly, there's also a reduction in the Gini, which also highlights the point that Santiago made, that many of these deductions are accrued by people in the right-hand side of the income distribution. The second reform scenario I mentioned is removing deductions and putting on top an EITC, of course, reduces revenue because you're paying this labor subsidy to some individuals, and also it improves equity, but the recipients of these tax credit are low-income households. Let me go a little bit on the motivation of this EITC, which probably Carola will spend some time talking about, but because she has done work on this. But the motivation for this, as I said, is to try to counteract the potential growth effects of these PIT reforms by fostering labor force participation. And importantly, this fostering of labor force participation, we think could benefit especially women and people that are in the informal sector. So it will bring formal workers into the labor force. It will increase formality in the region, which is also an aspect that could boost growth. Finally, let me talk a little bit about one issue that I'll come back later, which is the issue of social security contributions. We think that this EITC can be used to finance the social security contributions of the budget to reduce what is another side of the coin, which is the labor tax wedge in the region, which is something I'm going to discuss now. So basically, one thing that you might think of this PIT reform is that increasing PIT effects may discourage, especially those that don't receive the EITC, of course. But what we see is that despite the fact that once you correct for informality, which is the graph on the left panel, the labor tax wedge in black is very close to the OECD. So the labor tax wedge of formal productive units is comparable to the OECD. The main force behind this is not the PIT. So if you look at the right panel, you see that the gray portion of the bar, which is the PIT contribution to the labor tax, which is quite small with the exception of Mexico. Throughout Latin America, the median worker, which is what we're showing here, pays basically 0 PIT, which means that this is not affecting their labor tax wedge. So the bulk of the labor tax wedge in Latin America and the Caribbean comes from social security contributions, both from the employer and from the employee. So we think that if our concern is labor force participation, this is a bigger area than thinking about the PIT. Next slide, please. So let me go to the concluding thoughts of the presentation. Let me just summarize very quickly the results, which is basically to pay more attention to direct taxation, an area of taxation that has been generally neglected in the region for many reasons, and I'm going to come back in a few points. And these reforms could raise revenue. Some of these reforms could and proper principle have an adverse impact on growth. This can be mitigated by well-crafted reforms. There are three areas that we touch upon in the chapter that we think are important but require more research of potential sources of revenue. Two of them have to do with property and wealth. So one is the state tax, and the other one is the immovable property tax, which in the region some countries use, but we still see some areas for improvement and potential increases in. And the other tax that has gained prominence, especially because of the issue of climate change, are environmental taxes. I'm not going to talk much about this because we have a full Rio chapter devoted to this issue, and I invite you to go to the link that I posted on the chat and have this and look at this chapter that has some of the challenges of climate change and on the region, and also the issue of environmental taxes. And let me conclude by saying that we're fully aware that these reforms are sometimes difficult to implement for several reasons. So the most obvious reason has to do with the political economy of them. We understand that these deductions favor some people. For example, in the case of the PIT or even in the CIT, they favor certain individuals, certain firms. So removing this will require a broad dialogue in the country to be able to bring parts together and reach a consensus. Otherwise, they can backfire. These reforms can backfire. The other important issue is that sequence is important, and the timing of the reform is important. So the proper conditions have to be in place to be able to have a successful tax reform. And finally, it's important to mention that different countries will have different preferences over how progressive taxation has to be and which items of government consumption have to be financed. So this is important to have in this broader conversation at the societal level. And to conclude, just to mention that we are fully aware also that these reforms require capacity building and implementation ability. So tax administration capacity building will be crucial in addition to the reforms we mentioned. And there you can find, in addition to the link I posted on the chat, you can find the link to the report. Thank you very much, and we look forward to Carola's comments.
Thanks very much, Samuel. Carola, the floor is yours.
Let me stop sharing.
Thank you. Here I am sharing the presentation. Let me see, 1 second.
Sure.
Yeah.
All right.
You are seeing well?
Yes.
Okay. So thank you very much. It is a big pleasure to be here and being invited by Jorge Rondos and the authors, Samuel, Santiago, that also we have been exchanging research in the past. So I think you did a really great paper, a really good chapter on the subject. Let me see, because I am losing. The sharing here. And that this chapter is very welcome now after the pandemic in Latin America. You are seeing the presentation?
Carola, we lost the presentation.
Okay.
So you're gonna
I don't know what is going on. Here it is.
try sharing again.
Okay.
There you go.
Okay. I am having some trouble.
There you go.
Okay. The paper seeks to explain with how to change tax policy to make a more, to close the fiscal situation we have now, because we have a very large increase in fiscal deficit, and we have a big problem with debt. And of course, most of the fiscal problems in taxation come from the past, no? We have been having very large problems in our fiscal policy to increase taxation and to being close to taxation in an equitable and growth-friendly way. The document seeks to outline these reform options to improve collection in a growth-friendly manner, especially how to increase total tax collection. A lot of research is very comprehensive. It's an excellent research integrating many dimensions. So they build on growth and taxation, how taxation impacts growth, that builds on the work of Santiago. And then they included micro simulations to see how to increase the share of PAT and making it more inclusive and pro-growth. There are important trade-offs that you have to take when you consider trying to make this structure more equitable and pro-growth in Latin America. However, there are some fundamental characteristics in LAC, such as informality and inequality, that can hinder better tax structures, but some improvements of features in different taxes can be put forward. And the authors make this very well. They do a very good job in providing many policy implications after they do a great diagnostic that we welcome and share. In the rest, I will focus on some possible extensions of the document and complement, as Jorge said, with the work I have been doing and with the fiscal management division in the IDB with the earned income tax credit and the negative income tax to foster formality, growth, and also better fiscal policy. In the extensions, I see that in some parts you use some part of the Latin American countries. In some parts you use the full sample. I will do an extension incorporating in the micro simulations also Central American and Caribbean countries that have some different characteristics. And in the case of the benchmark with the OECD that I also use a lot, in some cases it's not the best benchmark because the levels of informality and inequality don't seem to be even so bad even in the past. So I will use maybe some Asian countries, African, I don't know, South Africa, Eastern European countries that are more close as emerging countries as ourselves. Also, as you mentioned yourself that a good extension will be to study tax administration, how to strengthen tax administration, but I think also tax policy and tax administration interactions are very important to extend this and see how different taxes are better collected by the tax administration and what are the trade-offs in tax policy efficiency and equity and tax administration issues. Another important extension has to do with the analysis of the PAT and the CIT together. As you know, in OECD countries, they pay CIT on account of the PAT, and they tend to have the PAT larger, to have more accountable of dividends and so on than what they have in Latin America. And especially when I mix this with tax administrations, LAC countries' tax administrations encourage the collection of CIT because in countries with high evasion and informality, taxing large formal companies is easier and you get more, you get the 50 largest companies. There is a big area in the tax administrations that are large contributors. And so it's easier. This is one of the reasons. There are many others that you mentioned in the paper. It's easier to check the registration than the self-employed, for example. And if you put them together, OECD collects 11.6 versus 6% in LAC. So it's almost twice as large, while GDP is almost 3 times larger. On the right, we have been working to look at the overall incidence of the income tax, not only the personal income tax, but the corporate income tax. notwithstanding the problems we have in, what is the assumption we make on the incidence of corporate income tax. But on normal assumptions, we see that the whole income tax collections gets more progressive because the size of the corporate, of course, progressiveness or redistribution potential depends on progressiveness and the size of taxes. And given that the size of the corporate income tax is larger, the average tax rate of the largest quintile, for example, grows in most of the countries. So this is one thing to consider, maybe to try to study these interactions that we have and in comparison with the OECD. And in your graphs, that I thought these graphs were, so good because to explain this difference, if you put them together, you will get that corporate and personal income tax will get more in the middle as in the OECD. I don't have much time, so I will go to the complementarity that we have done with our work. Thank you very much for considering the earned income tax credit. We began working on a much manageable version of the earned income tax credit as it is in the US and in many countries in the OECD. The negative income tax, mainly as an instrument to reduce the informality subsidy. And as I will mention in a second, increase formality. And we also mentioned help by a boost to demand by lowering payroll taxes that you, in your case, you try to compensate the payroll taxes with this subsidy. In our case, we try to compensate the effect that transfers has on fostering informality in the region. And also this will allow us to make the income tax more redistributive. One of the reasons is the high level of informality that although it has decreased, it continues to be one of the highest in the world. And it is an informality that if you go to the first quintile is 80% of the first quintile in Latin America is informal, but still the richest quintile is 40% informal or with a self-employed, not registered. So there is a big problem both on the low side and on the high side. So on the low side, on lower wages, that's why we think the reason for, there are many, many reasons for informality, but the most important reasons have to do with high non-wage labor costs that, a lot of payroll taxes, on average 27%, and even in some countries 40%. They have a negative impact in formality. There are lots of papers showing that, but also non-contributory programs that were enacted in Latin America to decrease the bias that Social Security has to give only social protection to the formal wage employed. Although they were very progressive in decreasing poverty, they incentivize informality. And there are several studies, even in Uruguay, that you might know, Jorge, that when they introduced the program AFAM, they decreased formality in 8%. It was very good in fostering a decrease in poverty, but it has a side effect in decreasing formality. So we thought that tax policy should get into these programs and give them through the tax system, the transfers. So we are thinking doing this, of course, in a transition. Of course, the low human capital of poor workers is another problem why they are informal. No, but I'm not entering into that. So our first work is looking at this graph here of what is going on the left. If you are seeing the left page, where we have formal work hours on the x-axis and income on the vertical axis, and we see that these programs put you in a corner solution of going to zero formal work, because when the subsidy is taken out, you are on C with this demogram, this transfer. You prefer to go to this point because if the transfer is taken out, there is 100% tax on that transfer. So you go back to the budget constraint. So what we think is this solution that has been for many years proposed by Milton Friedman and many others in the past, that instead of going to zero, we increase always the reward to formal work on this green side. So if you start to work to the left, formal work hours, you move on this budget constraint and incentivize people to change behavior, of course. We are introducing behavioral change and move to the left and beginning to work hours while still receiving a part of this benefit. The benefit is smoothing out, is leveling out. No? So in our micro simulations that we did with 5 countries on the right, we have the potential formality rates using this model that you could get, that is about 57%. And as in your case, and this is we are very much aligned on this, women have much higher rates of formal participation of about 70%. It's much more important for women, and we also share with you that it's much better to put on an individual basis this earned income tax credit or negative income tax because of the taxation that women have when men are the main providers in the house. So, so why a labor? In our case, we promote formality and stop subsidizing informality, include all workers on the base of the income tax system. Today, as you mentioned also in your great chapter, only 10 or 20% of workers are in the tax administration systems or in the negative or in the income tax. This will be a very good way also to begin controlling informality, to have them all in the tax administration, you know, with negative and positive payments, mimicking what is the current income distribution in Latin America. It's very difficult to mimic the distribution, the quintile or the decile distribution in OECD with the current income distribution in Latin America. And I will show a graph in a minute. You generate more information with this and improve targeting, even of transfers. We think that this will be important to lower the fiscal inefficiency of spending also, no? Lower administrative cost, less tax evasion because of you mentioned also the importance of lower informality for low tax evasion that is rampant in the region, and reduce poverty and inequality without resorting to the universal basic income that many people are talking about, hardly affordable by any LAC country. So we did some micro simulations. These are very fresh. So when you put the negative income tax on the lower quintiles on the distribution, you get the path of the income tax much more progressive. So the progressiveness is not coming at this point because we didn't do much yet on the highest levels as you did, but the progressiveness and the strictiveness of this comes mostly from the negative part that mimics, what is going on in the income distribution in Latin America. So this, I don't have much time, and I think this is I congratulate you because I think it's great, and we should all continue to work on these issues to improve taxation and well-being in Latin America. There are many other things, but we can talk later about it.
Thank you very much, Carola. Very interesting discussion. Santiago, Samuel, I'm going to wait for the end for your reactions because there are already some questions in the chat. And I would like to give the floor to Guillermo Bulletin, who has a question.
Can you hear me there?
Yep.
Excellent. So congrats on this work. I think it's great that we start thinking very deeply as to have push here on the how to tax. I think that sometimes in the region we tend to inherit recipes from outside in a very likely manner. And I think it's great that as we discussed, issues of informality, issues of incentives are taken into consideration. On that front, some thoughts, great work. On the VAT front, as Carola pointed, maybe including Caribbean or some other countries that have low VAT rates could be an idea. We have a recent paper where we show that in the GIE, where we show that the rate at which you start the VAT matters a lot for how negative is your impact of increasing your VAT, meaning it's not the same in Argentina as in Bolivia. And this is important because sometimes if we go all the way to start working on the personal income front, I think we might lose the opportunity of taxing something that is easy to tax, especially in our country. So some thought to consider. On the personal income tax, I think it's great what you put in there, the tensions, the sort of conversion story of where we could go and so on and so forth. I like it a lot. As Samuel very properly articulated, these are not considering the behavioral responses of people, which is very important in LAC, especially because we have so many leakages where we can go, right? We can go to informality, we can go to evasion, we can have so many leakages that sometimes that assumption is particularly strong, I think, in a region like ours. We are finishing the project on that. And the last one, which is much more of a philosophical thought, is on the progressivity front. We typically think a lot on how to make progressivity through the eyes of taxes, but we know it's very hard. We know it's very hard to get it from VAT. We know it's very hard through the eyes of the personal income tax because, as you said, the personal income tax paid by the people who pay are similarly to the OECD countries. So I wonder if sometimes the discussion shouldn't be reshuffled to the progressivity on the spending side, which we're very good, as Carola has shown in most of her papers. It's very easy to target the people that need the most. So I wonder how you thought this tension that we sometimes see in the world where progressivity is aimed to be done through income. Thank you very much. Congrats.
Thanks, Guillermo. There's another question, Fabricio Sanzi. Basically, he's asking, what are the important things that you consider on a transfer from the VAT to a more effective VAT system? Maybe I can pick that one up and mention that we're not suggesting getting rid of the VAT. We're suggesting to top it off with a more efficient system of direct taxation. So hopefully that answers your question, Fabricio. And since we have 5 minutes left, if there are no other questions from the audience, anybody that wants to jump in, then I give back the floor to Santiago and Samuel to respond to the discussion and Guillermo's point.
Thank you, Jorge. Thanks, Carola, for the great comments, and Guillermo for your comments. A few thoughts, then I pass the floor to Samuel and Carlo as well. That is the third co-author of the chapter, to see where he wants to add some stuff. Carola, great points. What can I say? So I think we would need a big follow-up. I share everything, basically what you just have said. Just very simple reactions. The integration of the CAT and the PAT, of course, is a critical feature. It's very hard to address in general with cross-country differences, because even in Latin America, Chile, Ecuador are different from the rest. So this is very hard if you want to have a broader perspective, and we're aware of that. Issues of tax administration, critical. We completely share your views. I think you benchmarking everything, so nothing much to add. Let me say something important that you raised, I believe, is the issue of whether an income tax credit or a negative income credit should subsidize social security contribution or payroll tax, as you said, or or transfers. I think this is a very important discussion. What we found, and perhaps let me emphasize that point, is that if we think about the cost for formality, at least from our estimations, the largest part is the social security contributions. So to us, perhaps we need to have a more comprehensive perspective where we also look deeply into that, which is an issue that Santiago Levy has been raising over the years, right? And we try to emphasize that point, but you brought another one, which is we also need to look at transfers, where transfers are generating a trap of informality, and perhaps we need to start thinking about how to combine both aspects. Very briefly, you raised something that to me is critical, which is the gender gap in a sense, right? You didn't put that in those words, but you said, listen, the issue of incentivizing labor force participation, formalization has a lot to do with women. Reducing the gender gap is critical for the region. So we share your views, and we also think that this is something that we really need to think carefully because of thinking about, of course, income distribution, but about growth in the region, right? That seems to be a critical area. The rest, we would like to probably, if we convince our boss, is to try to think about how we can move forward with some of the elements that you raised. Very briefly on Guillermo's points, I share your views on non-linealities, let's say with the VAT and growth elements. I think there is also a subtle issue there, which is that even for, let's say, Caribbean countries where you may have lower statutory rates, the discussion of where to broaden the base vis-a-vis, affecting these relatively low rates also kicks in. But I share your views. There is no linearities in taxation in general in the VAT and the rest, but we also need to think about whether, especially now with middle classes that are hardly compensated, even in different countries with low statutory rates, we're thinking about even within the VAT, more on base initially could be relevant. But I share your views there. One point that you raised, let me finish here from my side, I think is also critical, is the issue of whether progressivity is driven by taxation or driven by transfers. We in a sense, show that implicitly, perhaps we didn't emphasize that a lot in the presentation, which is that the largest progressive gains in terms of Gini coefficient comes once you introduce the earned income tax credit. This points to the point that if we think about progressivity, is not enough the tax system, and the earned income tax rate is a way of thinking about the transfer. So implicitly, the point is there. Something relevant, and I pass the floor to my colleagues to think about, is that in our simulations, essentially the middle class gets unaffected. So, and this is very important to keep in mind. In the simulations that we did, it's just the top income deciles that get affected by the incidence of the tax. And one of the issues with the VAT and more general with other type of taxation is that the middle class often comes uncompensated, right? So this is something also that I want to emphasize, and that the issue of transfers affecting income distribution is critical. So we share your philosophical views in full. So now that I pass the floor to Samuel and Carlo to complement the points.
If I may, Samuel, can you give Carlo the chance, because
of course.
time, and then he hasn't gotten a chance yet.
Of course, and I can follow up bilaterally with Guillermo and Carola.
Thank you. Appreciate it.
No, I don't have a lot to add because I agree with Guillermo, and I think as a personal experience, doing this analysis really made us understand where all these tensions are. And I think one other element that hasn't been really addressed is that what is the underlying inequality in the income distribution to begin with, and the taxation or even spending can do so far, but underlying there's a structural problem of what is the income distribution, and even this cross-country analysis sometimes really clouds the differences across the countries, and I think that was the main challenge sometimes in trying to standardize this. And I think another point where you have this tension is really when you start thinking about progressivity at the household level versus the income level. So for instance, if you take the earned income tax credit, just to give you an example, if the thresholds are based on the individual earnings, you get a very different result than if you base them at the household earnings, because a lot of the, for instance, a lot of the females who benefit from the income tax credit might be mothers in two-earner households, and at that point, you're increasing female labor force participation, but you're doing so in the middle class. So it's not necessarily progressive, but it might be growth enhancing or growth friendly. But that's because you're starting to look at not the income, the individual level, but at the household level. So I think it's a very big issue, and there's obviously more work that has to be done and that couldn't be captured. But I guess our analysis showed it to us firsthand what these tensions are and how it should play into the discourse over taxation.
Carlos, why don't you mention the main hurdle that you guys found in moving from here to what would be an optimal taxation scheme? I guess the research community may be interested in that issue.
That's a good point. So when we, and I guess maybe if there are PhD students or researchers in the conference, they can take this up. But we wanted to start, just to give you a bit of a flavor of where we started this project, we wanted to work on the Merliz-Saez optimal taxation exercise. And I think that's what Jorge is referring to. And this is, it's a kind of theory-based approach to what is the optimal PIT schedule over the income distribution, thinking about the incentives to work relative to the amount of revenue that you would get at different points in the income distribution. And most of this analysis in the past has been done on advanced economies, and hence the main margin of interest has been the intensive labor margin. So, if I tax you an extra percentage point, are you going to work more hours or fewer hours? But when you get to Latin America, the main interest is in the intensive margin, the extensive margin, because it's about whether people work or don't work, and you have an extra layer, an extra dimension of heterogeneity, which is the decision to work informally. And obviously, the difficulty is that a lot of the expenditure programs, cash transfer programs, are done at the household level. So in order to assess the decision of one individual to work or not, you have to take into account the income of the other workers. So we certainly realized that in the time frame and the scope of the Rio chapter, we couldn't really tackle this issue. But it's just I guess it proves how an economic framework that sometimes has been taught for advanced economies really needs an extra layer of complexity when you start looking at the Latin American case.
Okay, sounds good. Samuel, since I crowd you out, I give you the final word.
No, thank you very much for everyone's comments and participation. This has been a very enriching experience, and I think the bottom line is that Guillermo's and Carola's comments, we realize that this is work in progress, and that we look forward to continuing discussing taxation issues both with the academic community and within the community of multilateral organizations. So thank you very much, and thank you to the organizers, by the way. Very good job. Thank you.
Thank you all, Carola, participants, and the team.